Joint venture is very easy to structure than a syndication. Hello everyone, good to have us here. Let's just quickly dive into what we have for today. Some of us have been wondering how we can get into multifamily or how multifamily can be structured. There are many ways multifamily deal can be structured, but I'm going to limit it to just two, and that is joint venture and syndication. We also have others, so proprietorship. We also have through a fund. I'm just going to limit it to just joint venture and syndication. Before I even go into this, I would like to tell you how I started. I started my multifamily as a joint venture. So this was how it was structured. I didn't have money coming into multifamily. I know this is similar to some of us. Not every one of us have that big money to put down a 25% down, 30% or 40% down. The ideal way for me was to do joint venture. And the reason why I decided to do joint venture was because I didn't have the skill to raise capital. I couldn't raise capital. So there was no way for me to do that. What I could do was I could use my knowledge, my ability, and my skills in exchange for equity on a deal. So what did I do? I looked for someone with the money and I offered the sweat equity. That was how we structured our joint venture. So the joint venture was structured as 80-20 splits. That was at the beginning, and that was because I was not bringing in the money. Most times people that bring in the money take bulk of the equity. It just depends on the agreement you have with each other. So that was how it was structured at the beginning, 80-20 splits. But as time started going on, I started bringing in money. I started making money from my deals. I started reinvesting the deals. So at that point, I had to call back for a renegotiation. So now that is not the level where it is anymore. But that was a very good way for me to come into multifamily because I didn't have the money. So for some of you that are here and you feel that you can't raise the money or something, that might be an avenue for you too. That's why I decided that I was going to discuss about JV and syndication. So both of them are similar in terms of capital raising because regardless, you have to still raise money for both. But the only difference is the way they are structured in their roles, the responsibility, compensation, and the way investors are involved. So those are some of the differences that we have. What I'm talking about today is actually very complex. In our next meeting, I'm going to break it down. I'm going to show you a practical example of how I structure my syndication deals and how I structure my JV deals. It's just up to you. The bottom line is there's some fundamental rules that you cannot take off and you need to structure it in that way. You can add or remove, but some of the rules are very, very important. Like for syndication, you can't take out the person is going to guarantee the loan. You can't take out the person that's going to manage the loan. You cannot take out the person that will provide the capital. So those things are very, very important. So the next webinar we're going to have, I'm going to do a practical example and we're just going to form a case study of a deal and how you should structure it. It's not all size fits. It depends on the case. So it's just going to be a template and you modify it to whatever way you want it to be. But just on this, it's going to be on the surface level. I'm just going to see the difference between the two. I've done a video about what a multifamily syndication is and who the two parties are. In the multifamily syndication, we have two parties, which are the GP and LP. So for parties involved, you have two parties involved in a syndication. A part is called the general partners and the other part is the limited partners. But for a joint venture, the parties involved, they are all active partners. There's no general partner, there's no limited partner. Everybody are all active. There's no passive investor. LPs are regarded as passive investors. So that is not the case with joint venture. So in aspect of involvement, LPs are passive, while the GPs manage the project. Indirectly, they are very active. But for a joint venture, everybody shares responsibility and they're all active. So if you are a busy professional, JV might not be for you, just depending on what you are bringing on the table. I'm going to go into that shortly. GP members, the general partners, have full control over decision making, whereas the limited partners don't have any control. But for the JV, control is shared among all partners. So all of them must have a say on any major decision that they are going to take. Then we also have in terms of capital contribution. Before now, when the economy was a little bit stable, GPs were coming in with zero equity. That means they were not even putting in any money. But now lenders are mandating that the GP or the guarantor should bring in about 5 to 10% of the loan amount. So GP contributes a very small portion, which is about 5 to 10% of the down payment, whereas the LPs are the ones that bring in bulk of the funds. But for JV, all partners contribute capital and skills. So everybody's bringing in money, everybody's bringing in skills as well. That's for JV. For compensation, GPs are actually rewarded with asset fee, acquisition fee, disposition fee. So if they buy a property, there's something called an acquisition fee for putting in the deal together and all that. There's a money that is paid to them for doing that. It's called an acquisition fee. Then you have the asset management fee. It's for them managing the assets throughout the period of the hold of the deal. And you also have the disposition fee. When they're selling it off, they also compensate themselves for selling off the property. So there's a fee for that. And it varies depending on your group. Some people take from 2% to 5%. Depends on your team, depends on what you want or what you're doing. 2 to 5% is the standard. Well, most likely it's 2%. Most people do 2%, but there's nothing wrong with doing 5% if you can justify it. The joint venture, there is no fee, nothing of this such. There's no acquisition, no management, no nothing. It's just your share profits. Whatever profits shares you guys have, that is what you go home with and all that. So for the liability, the GPs bear management risk. They have a large portion of the liability, whereas the LPs have limited liability. That's why they call them limited partners. Their liability is only limited to the amount that they've invested. Unlike the GP, it's not limited to the amount they've invested, it's limited to the deal. So the LPs have limited liability. That means only if they've invested 50,000 is their risk exposure. Whereas the liability is shared among the partners. So the risk, everything is shared among the partners. When do you decide to do a syndication deal or a JV deal? If the deal is very big, that is, you are raising a lot of equity down payment, you might need to consider doing a syndication. But when the deal is small, maybe you guys are raising 600, 800, 800,000, you might consider doing a JV deal because of the size. Because when a syndication deal, there are some fees you pay, some legal fees that you pay that if you have done a JV deal, you might not need to incur those kind of expenses. Typically, the standard for getting an SEC, because for a syndication, you use an SEC attorney to do that, and you pay between $15,000 to about $25,000. So you might need to reconsider that if your deal is small and decide to go the JV route. Syndication is highly regulated by the SEC. It's subject to security laws, whereas for the joint venture, it's not subject to any security law because partners are active. So once you're active, you don't have any passive investor that needs to be protected, and that does not apply to them. The next thing we're talking about is the pros and cons. Both of them are ideal and good, but you need to identify at what part, when do you need to use syndication and when do you need to use joint venture. I use both on my multifamily deals. I have both currently, and they both operate at different levels, and I manage them at different levels. For syndication, what are the pros for syndication? Passive investment for LPs. The burden is not on a general partner to raise the money. Pool of money comes from the limited partner. So that is a pro to it because the money is not coming from your pocket. That means you can actually do a multifamily deal and not have a lot of your money invested in it because the limited partners are bringing in the money. Then the GP controls the operations. Imagine you're not bringing in the money, but at the same time you own full control. Is that not fantastic? So that is the beautiful thing about it. You have a say, you control the deal, you operate it, but it's not your money. It's people's money, other people's money. And it's a good way for you to start bigger deals. Syndication is an ideal way for you to go into bigger deals, and it has limited partners as LPs. Then the cons, what are the cons to it? You bear all the management risk. So if there's something happening, like what we are seeing happening in the economy, the GP members are exposed to litigations, exposed to so many things at this point. point. So they're bearing a lot of risk based on that. The cons to it is that fees are charged by GPs. So you still have to pay the GPs for organizing the deals. It takes some fees, it's not free. They are managing it and they're still being paid for it. So that might be a con if you're looking at it from a perspective of, let me say, a limited partner. LPs don't have any decision-making power. Regardless, they're bringing in 90% of the money or more, and they don't have a say on the deal. That's the way it is being structured and all that. And it's subject to security laws. That is why we have the 506B and the 506C. Because of the security laws, there are some things that you cannot expose to everyone. There are conditions or there are legal things you need to follow. If not, you'll be in trouble. So it's really governed by the SEC laws. It's very important. Disadvantage about it. Then for the joint ventures, what are the pros for joint ventures? The pro is that all partners are jointly involved. That is, everyone has a say. And the structure is flexible depending on the agreement you guys have. Most times joint ventures are people that maybe have known themselves before now. They just decide to do a deal together. You guys can say, based on what I'm bringing on the table, I'm taking this. And you guys will come to a common concession and divide the deal based on that. It's not subject to SEC regulation. It requires complementary expertise. That is, the skills you don't have, maybe your partner has it. The skill the other partner does not have, the other one might have it, and all that. And you guys are pulling your expertise together and forming a team. But the disadvantage about it is that all partners must be active. That is, there's no room for dormancy. There's no room for being passive. So if you are a sojourn that does not have time for anything, you might need to reconsider if that is a good play for you. Then you share control. This might bring about conflicts because member A might not be in agreement with member B. And before you guys know it, you guys are coming to a roadblock because you guys cannot just come to a conclusion. And because of that, you might directly affect the deal because you guys are not in a common page and all that. It's only good for smaller deals because imagine you having a $50 million deal and the raise is about 30 million. Doing a joint venture on that might be very difficult. It's not even advisable because you're putting a lot of your money down. Joint venture is typically for smaller deals, and the liability are shared among the partners and all that. So that is the pros and cons for it. Then I'm going to give you a sample. This is just a template. I'm going to break it down and tell you how a GP can be structured. So this is for a GP. In a GP, like I said earlier on, we have two roles, which are the GP and the LP. So for the GP is going to handle the acquisition, assets management, investors relations, the dispositions, and they will manage the day-to-day operations. It's not as if they're the ones doing the day-to-day operations. They have the property manager to manage it, but they will be supervising or they will be monitoring what the property manager is doing. So these are details of what a GP role entails. A summary. For an LP, your duty is just to provide the capital and you receive preferred equity and also profit split. So for the GP role, I'm going to break it down in our next meeting and divide this into percentage. It's not a standard. You can fine tune it to how you like. It's just up to you. So for the GP compensation, we have the acquisition fee. The standard is 2%, but I've seen people doing as high as 5%. So acquisition fee, 2%. This is how it's structured. All these things go into the document. Asset management fees between 1 to 2%. Promote or carried interest, and that is the GP split. Most times it's between 20 to 30% of the deal. For the preferred returns, we have 7 to 8%, depending. That is an average standard. It's not as if I've seen people doing 18%, 12%. Then profit splits, 70 to 90 splits. I've seen 50 to 90 splits, depending on that. So this is a standard way of structuring a GP deal. For a JV deal, assuming you are, let's say, 3 partners on a JV deal. Let's say one of them brings the deal and the other person brings the equity and another person has the skill to manage. The 3 of you can partner up I know how to find deals. Another person can come up, I can raise the entire equity. Another person will come up and say, I can manage the deal. Or partner A is finding the deal and securing the deal and overseeing the entire acquisition process. His capital contribution is 500, small contribution. Then we have the partner B, asset manager. His duty is to manage operations and leasing. His own capital contribution is 500. Then we have partner C that is carrying bulk of the capital raise. His own capital contribution is 2 million. So based on this, you see, because he is bringing a lot of equity on the table, that he can decide that 60% will be my share and you guys will share 20%. And mine, I was bringing $0 and he was bringing the entire 100% down payment for the entire deal. So mine was 20% and he was taking 80%. It just depends on what you guys feel like doing. If it's a very heavy lifting deal, you might decide to structure it because I'm going to manage this property. It's a lot of work, a lot of this. I might decide to take 30 to 40% and you're bringing in the equity at 60 to 70%. It just depends on both parties and all that. So in other words, joint venture is very easy to structure than a syndication.